Welcome to Market Monkeys.
This week we're going to be talking about cost averaging and also compound interest and how they link to each other.
Let's get into it. Oh, and by the way, if you do like this, subscribe. It doesn't cost anything. We need more subscribers. Come on. Okay, let's talk about it, Scott.
Okay, first we're going to talk about cost averaging. What is cost averaging? Well, cost averaging is basically what you're doing is you're taking a portion of money, same amount every month, for instance, and you're going to invest that money continuously every month for a certain period of time, right?
Yeah.
So say for a year.
Yeah,
right?
throughout the year.
So say you take $1,000, if you have $1,000 or $500, whatever you have, $1,000 on the same company every month, whether it be higher or lower in price on a certain company. And what you're doing is you're averaging the cost through the year.
Yeah.
So over time, whether it goes up, whether it goes down, you're just consistently buying, and that's cost averaging. It works out really well.
And in the past, I know I've bought, unfortunately for me, I've bought high and I've watched my stock go down. So I then, at intervals, if it's a good drop, I go in and I buy more. If I believe in the stock, which I wouldn't buy it in the first place else, but if it does drop, I then buy it down, down and down, and then my cost average comes down. So
the cost of the...
Yeah, and it's obviously...
But the idea with cost averaging is that the higher the price that you're paying, the less shares you get, and when it takes a dip and you're still consistently buying, you get more shares for the same amount of money.
Yeah.
So that's where it comes in beneficial, right?
Just showing the two ways we could do it.
Exactly.
Yeah.
So the other point we're going to be talking about today is also compound interest. So this is over the years where you say, for instance, we're going to start with, say, a 10% per year. Say, for instance, that if you would invest $1,000 and you made 10% compounded over 10 years.
Yeah.
Okay. So in the first year you'll make 1,100, the same as you would if you weren't to compound the same interest. Then the second year you'd be making 210, whereas if you didn't compound it, you'd be looking around about the 1,200. Did I say that right?
I think correctly. Yeah.
For the third year, you'd be looking at compounded 331 from your original amount, where it's compounded. Where it's not compounded, you'd be looking at 300. So you make an extra $31 over 3 years because it's compounded year over year.
Yeah.
What you're essentially doing is the money that you've made from the year previous is then also making money the year after.
Yeah.
So in 10 years' time, for a non-compounded interest of $1,000 at 10%, you're looking at you've made about 100%. Whereas if you'd have done it compounded, you've made around about 16%. Sorry, 160%. So you're making an extra 60% more by compounding.
Yeah. And what you're doing is you're keeping your dividends. And don't forget, in amongst your 10% growth, and you get your dividends sometimes on top, unless that's all rolled into one, and that's what you just keep going forward. Because obviously most people, not everybody, well, like myself, not working, but most people are working and living on that money, and then you compound it to go forward. That's how you expand your portfolio, because you don't have to buy the same stocks with the money. You just buy something else that goes forward, and you're going forward at every angle. Mm-hmm. And that's compounding. That's right. Compounding is the way to make money.
Because the money that you've just made is now going to make more money for you, rather than just the original amount making money. So you have dividends coming in, then you reinvest those dividends, and those dividends will also make 10% on the money that you've reinvested. And
you also change the scale that you're at, because after a period of time that you've been investing, the size of the scale the amount of stock you buy, the scale becomes the word that means everything to you, because your scale is what just makes the money. You know, if you've got a large amount in and it goes up a lot, you make a lot. If it goes down a lot, you just go down a lot. But scale is what you
look
need.
At it. I like to look at it percentage wise, because sometimes when you have more money and you see it drop by 5% and you start losing, 20, 30,000, you start thinking, oh, something's wrong. But But if you look at percentage-wise, try not to look at the numbers so much. That's what I find seems to help quite a lot. Then you can rationalize things a lot easier. When you see a 2% drop, it's not, you don't have to panic so much. Although you've lost, say, 20,000 in a day, you start thinking, oh, it's okay because it's only 2%.
Yeah.
So it's not going to ruin the year, right? And this is where you want to be doing it for the years, not for the days.
And you know, when you say 30, 20,000, it's not a lot of money, but it is as if you're an individual. It's not for institutions and people like that and funds. It's not a large amount of money for them to lose that amount of money. But for an individual, yes, it is. And you know what? Like I've said before, yeah. I mean, I have lost in the past quite considerable amounts. But once again, if you stick with the stocks, if you think you've got a good stock, you're good.
Well, this is part of basically a strategy, as we've talked before. So cost averaging and also compound interest is part of a strategy that you can use in your portfolio. You may not want to use it, but it's a possibility.
And that's what I've always used. I've always used that. Yeah. Cost average, I'm always buying on the way down because if I believe in a stock, which I normally do it before I buy it, if it does take a drop, I start cost averaging if it comes down, because odds are on that it's going to return to its original level. And as it's coming up, my cost has got halfway in the middle. I'm already back into profit a lot quicker than I was earlier. Even though I believed it was that level, I'm much better off and I got that much gap now. It makes a difference. Makes a lot of difference to me.
It does make a lot of difference.
Yeah.
So that's all we got for you today, and we'll leave it at that.
Market Monkeys over and out.
Subscribe.
And don't forget to subscribe.